Good afternoon, everybody. Welcome back to the Schwab YouTube coaching channel. It's the afternoon edition here of Building a Stock Portfolio, and I am your host, Kevin Horner, joining you from Chicago, Illinois. I'm very lucky to be working out of the Chicago Schwab studios today and the rest of this week. But we are here to take a look at an example portfolio that we've been managing and take a look at some of the example trades we attempted to place last week, see how those went, take a look at making some adjustments to our existing portfolio, of course, and building out some new examples thanks to opportunities presented via our screener tool. So with that, I'll let you know we're joined by my friend and fellow coach, Connie Hill, there in the chat. Connie is a fantastic coach and wonderful educator. She's extremely knowledgeable and certainly will be able to answer comments and questions that you all leave there in the chat. I'll keep an eye on things as usual so that we can bring your questions and details into the conversation, but don't hesitate to post in there. Remember, we go about 45 minutes in total here. We're going to spend the intro portion with a brief market review before we get to a look at that example portfolio and our trades from last week, like I said, and then we'll spend the final portion here, hopefully the last half, building out some example trades. I've got three examples that I'm prepared for. Let's see if we've got the time to get to all of them. So with that, yes, of course, it is Tuesday and Taco Tuesday always. However, I'm in Chicago. That means it's probably Italian beef, spicy sausage, etc. Maybe some tavern-style pizza. I've already been speaking with my friend Bree pre-show about this stuff. I'm already excited for my afternoon. I intend to be spending my evening at Wrigley Field tonight, taking in the vibes and the atmosphere there, and in celebration, believe it or not, of what is my 29th year at Schwab today officially. So with that, let's get to the disclosures so that we can jump to the charts. First of all, remember, everything that we cover for you today should be considered informational and educational only. We do not make any recommendations nor endorsements for a specific approach to trading the market here. What we will offer you are concepts and strategies of technical analysis that traders may choose to employ on their own. So please, as always, do your due diligence. Don't take anything that we bring to the table today as a recommendation, of course. And when you're thinking about technical analysis, remember that technicals should be considered simply one piece of our decision-making puzzle, not the entirety of it. All right, so let us take a look at our S&P 500 here today to see how we finished out the day. Of course, we had a little bit of a rocky conclusion, it would seem. We've got a red candle on the chart here today. I'm going to zoom in to just basically the last 2 months or so, going back to our bottom here in late March, that is. And yesterday we were quite enthused, of course, with this beautiful gap that we made through the 20-day moving average. And today we did not make a higher high, didn't trade through the high of yesterday. So we've bled through a little bit, if you will, back to the 20-day moving average. And it surely could be a potential zone for short run support if you are that trend trader with a defined confirmation signal. Maybe you're a trader looking for 2 days above what was a resistant moving average. In this case, you may be feeling confident already. Today's weakness could offer the S&P trader who likes the 20-day an entry opportunity much closer to what they deem to be support. Now, I don't know if the 20 is going to offer that for us, of course. We'll see over the next day or two in the shortened week, but many traders will take away the fact that the 50-day has provided some substantial support for us, and we've got a nice gentle upslope to that 50-day moving average. So 72.70 is where that approximately resided at this morning's test movement. After all of the action here today, we're up to 72.85 on the 50-day moving average here in the S&P. So we'll see what tomorrow brings us. It is an FOMC decision day, but not, or rather, we're going to be hearing from the Fed tomorrow, I should say. But I don't think you're going to see fireworks works per se tomorrow. But I'm going to always suggest that while that might be my anticipation, we have to stay open-minded to the possibilities. Now, some similarities here. The NDX, however, with a bit of a deeper red candle. As you can see, we got through the low of yesterday with some conviction here today. So we popped into almost to the same highs. We made a lower high with yesterday's move, filling in the gap here today. Maybe tomorrow, what some traders could be thinking about is the potential for a weak open that would put us in the neighborhood of the 20-day and those prior highs. And then it would be possible to consider a gap to have been filled, offer short-run support. As always, whether you're watching the 20-day or the 50-day, if you're thinking the 20 holds up, have some step that you'll take if it doesn't, and then subsequently have another step that you might take if the 50-day doesn't provide support, right? What is that step? Maybe it's selling 10% of your positions, maybe 15% or more, but define that for yourself in advance. It makes the decision making so much easier for us. Now, the Russell also breathing today, even though yields have come down quite a bit. So Russell pulling back short term to the most recent highs could be support. But the 20-day has been, and actually below the 20, has been a little bit more consistent for us, hasn't it? If I cleaned this up and just eliminated my lines, and then let's just focus on these tests here. Both of these tests came in windows of volatility for the broad market, and they've managed to have led to subsequent higher highs. So we really can't take this as negatives. Pullbacks that are under the 20 have been chances to join into the trend. So we just need to see if that's going to continue going forward. Could we hold up here? Sure, but I think some of that's going to be tied, of course, to the 10-year. You all know, if you watch and pay attention and keep engaged with me during Trader Talk sessions, you know we're watching the 10-year closely. So today we have the 10-year pulling back to the 200-day. No, excuse me, that's not the 200, that's the 50. And we are now 10 basis points beneath where we were. So we were at 455, we're now at 445 approximately. So we've seemed to have rejected yields at that 4.5 area. And you know, again, if you've been watching, and you've heard my commentary, you know that I was calling out the importance of that 455. Can we stay beneath it to give tailwinds to the Russell? And we have maintained beneath it. Now that we're at an area that could be considered supportive for the yield, boy, a move under the 50-day would be a wonderful occurrence for the Russell. Has not occurred. We're sitting on support. We won't jump the gun here because a breakdown has to start occurring before we can believe that that's what's on deck here. So could it be? Sure. But if you're a believer in the Russell and you want to be long Russell and you want to use yields weakening and decreasing as a reason for it, well, then wait for a close in the yield under the 50-day moving average at least. We haven't seen that since back in at the beginning of March, which is when we started to rally the yields. That was when things started to go south a little bit, and obviously that is tied largely to what happened with our conflict there in the Middle East. Okay, so there's a quick rundown of how we finished out the day today. Let us take a look at what we tried to do last week. Last week we led with an approach that said, hey, let's get into technology. And so first of all, I should show you, let's look at the tech chart. It was red today. We lost about 2.25%. So you can see technology made a move out of what I should say is we broke the downtrend, right? And a downtrend line break is commonly an area where traders will look to expose money. And now that we've pulled back a little bit, maybe this is giving opportunity for us. But you know, the 50-day has been really consistent here. Here's where the 20-day is. You can see we were above it for just a day. So did we fill the gap? Well, not entirely. I think it's really close. The high from Friday was 67.10, just shy of it, and today's low 67.42, and we closed right on the low. So we've got a little bit of wiggle there, I guess, about 30 points or so, very limited amount in percentage basis, but let's see if we can't get back right above that 20-day quickly in tech. Last week, the trade we went for was, I'm going to go to my monitor tab here and then to the statement. You can see the trades we placed. We placed two separate buy orders trying to buy APH in a bracketed trade. What do I mean by bracketed? Well, our goal was to step in on a breakout, and I wanted to be able to protect that position fully, even if we got us into the trade and it ran to our target and we sold half, which was our goal. So we split that trade in two. We bought two separate 25 share lots on a buy stop order at 157.52. We got placed into that trade on the 10th, right in the morning, first 15 minutes of trading, and then unfortunately in the final hour of trading we got kicked out of that trade. So clearly a fake out breakout is what we got. Let's look at it on the chart. Here is APH, and our thought was, I'm going to go with a 200-day simple moving average on this. Let's go back to a 1-year chart from my 6 months. And see, this is the rangy approach here, right? And my thought was, if we could get a breakout with some legitimacy, we have the opportunity to just run. And we did not get the run. So we got the break, but we didn't get the run out. So here's where we zoom in a little bit, and I'll show the candle here. At one point, this candle was filled in and green and gorgeous, and it looked like we might be good to go. And unfortunately, it just gave back too much. And so my thought is, all right, what can I do to fix that? Did I need to do something differently? Did I use an improper percentage, below the breakout spot? So some of that math could always be reviewed and altered in the future, but it should be a learning lesson for me. We lost on the trade, but the concept of the trade still holds. And so if you were interested, as an example once more, to try to see if it works again, one easy way to do this, we just go back into the monitor page and we go to the order history for APH specifically. And so we can go back the week here to the 9th, where we've got this APH buy based on the stop, and we can do a create duplicate order and reestablish. So just as a process, if that was something a trader were looking to do, that's how you might do it. Exact same process that we built originally would probably fit. And now that the stock has shown a move and a hold above this level, yesterday was the highest close we have seen since the gap out of it here. So this last 2 days is certainly improving, and it might be resetting for a trader's consideration. So we got stopped out, we took a small loss, but the reminder needs to be, that's what we were planning for, meaning obviously we're planning to profit, but in this instance, the profit situation didn't play our way, and we ended up losing an amount with which we had comfort. So that's okay, right? Taking losses is part of the game. Taking losses, we need to be comfortable with that. In fact, it's often stated that as traders, we need to not just be comfortable, we need to be happy to take a loss, because it means that we followed our process, and sure, we didn't make a winning trade, but we stuck to our process and our plan, and that's what we want to reinforce. Okay, so let us take a quick look at the monitor tab to see how the existing positions are working. So I'm going to bring that up here. We've got only 3 now. So we have Dollar Tree, which was recently a set, and EW here, Life Sciences, and Morgan Stanley. So let's take a look at these 3 real quickly, see if we need to raise the stop orders on these. Let's take a look at Dollar Tree. Now, we're not going to make a lot of changes here. Looks like I've got to get my orders in there, so I'm going to place my order details. All right, so we're bracketed here. Nothing has changed on the position in Dollar Tree. We were holding to the gap. riding the 200-day moving average as support. We used the 200-day less the amount of the average true range to build our stop. We have a target essentially at the prior highs. We own 75 shares, and our target zone up there comes in at 135. So don't need to do anything here because we have a risk-defined trade. If we get up to the 135 and we get taken out, terrific. Then we've got a profitable trade, and hopefully that's what plays. But if not, we are at least protected to an amount of risk for which we have comfort. We can't guarantee, of course, that we'll be exiting at our stop price. As we know, our stop is $100.77, but because we're using a trigger of the stop and then it triggers and becomes a market order, we can't guarantee that price. So let's go ahead, we'll leave this one as is because we've not made a new high yet. And if we get Dollar Tree to make that new high, well, then we can talk about elevating and raising our stop order here. Let's take a look, make sure don't have any questions. Oh, thank you all for the kind words there. Connie at 10, yeah, I sure do wish that I was only 39. Let me just leave it at that. I'm certainly not, unfortunately, but my time here at Schwab has been a fantastic experience for me. More than half my life at the firm. I'm very pleased to still be here, obviously. So, but thank you all very much. Okay, let's look at EW here, everybody. We're going to jump to EW, click that 5, we go back to my chart grid, and let's see where we stand. All right, so we do have let's go ahead and get different moving average in here. 50-day is down here, and I think we've been building this against the 20, and sure enough, we have. So the 20-day has been rising for us, but boy, look at how the ATR left us favorable, at least in this instance. And again, we know this is not going to happen every time, right? We get stopped out. That's the game we play. However, look at this low. This low was 83.17, and our stop was 83.03. We missed it by a mere 14 cents. So conveniently, at least in this instance, the ATR helped us weather this storm of selling on the day Friday, and we stuck with the trade, and now we have gapped. We get a gap move higher today, 2.6%, positive, love it. So let's see about elevating our stop a little more because the 20-day clearly has risen over this period. So the 20-day today is at 86.05 now. And if we go ahead and add in our average true range, it's 253. So 86.05 less $2.53 puts us at 83.52. So we can elevate this about 50 cents. Now, not every trader is going to look at that as a need to do, right? That's only 50 cents. Some of us would feel a little better about just sitting on our hands and letting it have that extra 50 cents of wiggle. But we're watching this clearly and intently on a week-to-week basis. Let's go ahead and push this up by that 50 cents. So we're going to go up to 83.52, a nice not round figure, of course. Here we go, 83. Oh, wait, hang on a second. Did I misread that, everybody? This stop could still. All right, it looks like we've got me back, everybody, I think. Okay, we are back with Morgan Stanley here. We're making an adjustment to our existing exit strategy on the example trade we have here in Morgan Stanley. So we're going to take a look at the 20-day moving average, which has been, boy, everybody, look at how supportive this has been for Morgan Stanley here back to the end of March. This has done well for us. So our 50-day moving average today is at 208.25. And our ATR down below, you'll see it, 596. Go ahead and reduce the amount by that 596. and that tells us our new stop should be 202.29 approximately. Here we're in at 196.94, pretty good level for us, so we have a chance to raise our stop by about 6 points. That's a nice adjustment. So I'm going to right click on this one just to remind us that we don't have to click and drag that order type. We'll do a cancel replace, and we're going to put it in at 202. My math says 29 cents, but we're going to go down to 27 just for giggles here. So 202.27, good till canceled, confirm, and send, and now we have raised our stop by an appropriate and comfortable amount. Okay, so that's where we stand on our example portfolio, which continues to work. Of course, recognition once more, we're not going to continue to work 100% of the time, but if we follow our process, we are greatly improving our opportunities and consistency for what we're trying to accomplish here, and that's very important. Now, let us open this back up. Let's close down the market. I'll open the scratch pad as a reminder of what we strive for here in this class, and then I'm going to remind us all about this process that we're utilizing, which is fairly basic. Now, I keep it basic because a couple of reasons. The first of which is the reminder that we don't have to be advanced to be good traders. Often we need nothing more than prices and trend, right? We can simply monitor price action and watch trend for entry and exit scenarios to consider. Can we add more indicators and oscillators and the like? Of course we can, but that doesn't mean we have to. And in this, the goal of this class is to work through simple ways to hold our positions for as long as the trend continues. And that's ultimately what many traders are really trying to accomplish, sticking with stock for as long as the trend runs. And when the trend shifts, well, then we make decisions, then we change. But in the meantime, if the trend is still going, the idea that makes the most sense from a trader's standpoint is to stay with the trend until it shifts. So that's the ultimate goal here. So today we stepped in to look at technology, and that's partially because of the narrative shift we've had. Right, this week we get the hopeful completion of the Iran conflict, which could lead to some positivity for the broader markets. We've seen yields down, we've seen the U.S. dollar down, and we've seen oil down. All three of those going down is a likely lift and tailwinds for the broader market, not headwinds. And so let's take that as an optimistic view based on recent news. With that in mind, I utilized our very basic scan looking for technology stocks above their 20, above their 50, and above their 200-day moving averages, all three. So we've got trending against three various windows of time. That's a process that lets us know that traders in three windows of time are validating uptrends. That's a positive for us as well. So I'm going to show a few symbols here on stocks that are moving in this space, and then I'm going to show you three example trades that I built pre-class based on how the patterns are looking. So I did pick on a couple here. But let's just take a look at what's showing up on the list. We've got Western Digital. You'll notice, in fact, I can speed this up. Let's go just to the 6 months so we can zoom in a little. Look, I mean, this is fantastic too, right? Riding the 20-day, instances below the 20, opportunities for participation. Seagate, something similar, 20-day again, breaking out after having tested the trending support and horizontal support. So you had confluence of support right through here, right? So, have a clear structure to what catches your eye. What is it you're looking for to establish some of these positions? Here's that APH we looked at. We know how that finished out. What about NetApp? All right, here you've got a pullback to the 20-day after a wonderful gap move following earnings here, right? Now, even still, this one is not one of our examples, but I'll just point out the pullback has been sharp. The volume decreasing in the pullback is what you want to see from a pullback standpoint. And when we notice down below that the RSI has been bleeding a little, but it's bled down to like basically 58, 59, 60. I mean, this is also bullish regime action in the RSI. So, traders looking at the lows of the last week are going to note that they haven't broken below about 154, 155, and the 20-day is right there. So I could certainly see traders potentially building an example trade against the 20-day moving average and maybe incorporating an ATR, or as a reminder, we use only one ATR, but some of you want even more wiggle room, right? So you might consider 1.5 ATR, even 2 ATR where appropriate. But a lot of these positions that you'll see in tech are going to be big and volatile, that is, and that can lead you with a need to be tighter in your exit strategies. Or, as always, just remember that if you are giving it a wider berth and you want to use 1.5, 2 ATR, well, that should mean that you're shrinking the position size down, right? So keep that in mind. All right, well, let's go ahead and look at some of the trades that I'm prepared for us from an example basis. I've got, these are all making the same list, everybody. So let's look at Keysight. KEYX. We had a red day today, but the reason that Keysight made the list for me today, beyond the fact that it's already matching up with our scanner, is that it broke this diagonal downtrend line, right? And for a lot of traders, the break of the downtrend becomes an opportunity for an initial entrance into the position. Now, there are a few things that could fly differently for some traders. You'll notice here that recently the rallies have lost a little bit of steam, right? So our rallies have come into the mid 50s or low 60s, and that could be considered a bit of a bearish regime view, if you will, as it relates to RSI, but we're not gonna sweat that because we are looking at the confluence of the two major moving averages, the shorter ones, that is the 20-day and the 50-day right here. So those are basically on top of each other. If I was to, let me go ahead and hide the 200 here, just so we can look at the, and you'll notice at the top here, as I put my cursor on it here or go over to the far right, these are basically within 20 cents of each other, right? So the moving average is at 342, basically. That is confluence and support. So a trader who wants to build against those makes sense, right? Thinking 342, approximately less the amount of the ATR. So that's what I've put together for an example here. So I'll walk you through this. We're looking at basically entry, which could be in the neighborhood of up to 351, maybe 352. Okay, so, and again, close today was under that. So if you go to a limit of 351 or 352, I call that at least a padded limit. The goal is I want to be in the trade, but only if I don't put, as long as I don't have to pay for greater than X, whatever trader defines that for themselves. So we're going to go with 352 for our order entry. Initially, I had it at 355 when I was building this, so the stock has come down a little further for us. It's going to limit our risk factor quite a bit. So the math on this, if we're using this confluence at 342, then we go below it by the amount of our average true range. That's $14.15 now. So the range expanded a little today. But that basically means entrance would be in the neighborhood of 352, exit in the neighborhood of 328. So 352 as our maximum cost on the trade. So we'll go with a limit at 352, less a worst case exit with a stop at least is 24 points of total risk, okay? And I say worst case exit, obviously I can't worst case the price range, right? Because it's a market order once it triggers. So what we'll look for is basically 24 points of risk on a 25 share position, which would be a maximum of approximately $600. But again, we can't adhere to that. But that's cool from a risk tolerance standpoint based on our calculus here, right? We want to make sure that we don't exceed a $10,000 position, and we want to make sure we don't exceed $1,000 of risk approximately. So 25 shares at a limit of 352 will accomplish all of that. So we'll go ahead and build this with just a stop. All right, close this here just to give us a little bit more room. All right, and so what we're going to do, just change this to 25. Make sure those line up. This will be for tomorrow only. We'll go limit 352 or better, right? Or better in the buy side, always considering that this price or lower. So good for tomorrow, better than 352, and then exit will be at 3. I wrote that down wrong. I'm sorry, everybody. So we said 14.15 from, all right, from 342. There we go. So let's go to 327.80 something or other. 327 in a nice odd figure, 327.83. All right, and that one needs to be good till canceled. Okay? So let's go ahead and just take a quick peek. Now this is going to basically be a full position size for our comfort here, okay? So we're going to let that go. We'll hopefully see that this rallies out of the brief pullback here, but if not, we're going to lose an amount we have comfort with. So 25 shares in, not to exceed 352, and worst case exit here on a stop is 327.83. That'll trigger and then become a market order to sell, so it gives us no price guarantee. And that'll be good starting tomorrow morning. Okay, so there's one for us, everybody. Next on this list, how about Dell? My goodness, Dell has done some exceptional movement here since breaking out in late February. We've had a big range here, by the way, but look at how volume just dried up as we've built this little pullback. And then you've had yesterday's action, Friday's action, today, break of the downtrend line, hold of the 20, all of that remaining consistent for us. So in this example trade, it's going to be all the same stuff, and that's okay. We want to get good at doing the same thing over and over. This is how we build a process. It gives us that consistency to stick with, right? And over time, that consistency will benefit us. Now, we're looking here at entry that needs to be probably in the neighborhood of maybe 405 or so. My notes suggest that we're going to be a buyer around, let me see here, 410. So we can go as high as even 410. And again, this is really just us managing risk when we put a limit at 410, right? We are willing to be a buyer up there. Doesn't mean we're going to get it, we're going to buy it up there. If we open tomorrow at 399, we'll be a buyer at 399. That's or pretty close to it. That's fine too. But we want to use it to make sure we're within our comfort for risk. So 10 shares is what we'll consider here because, man, the stop level on this is a ways away. So our current 20-day is 363.29. Okay? 363.29 on the 20-day, and our ATR is now 36.57. That's not small. That's a pretty good range. So that gives us an exit in the neighborhood of 326, okay? And that's about 84 points of risk. So if we're risking 84 points and we're comfortable with only $1,000 of risk, we can only own 11 full shares. So we're going to own fewer. We're going to own 10, all right? Or we're going to put ourselves in a position to be a 10-share buyer here, all right? So once more, a little buy custom with our right click and with stop. Here we go to a limit of 410 for tomorrow's business. Again, we need to adjust the share amounts. 10 shares is all we're good for. Make sure that we're selling 10 on our stop. Our stop does need to be good till canceled, and we need to get it in at 326.72. Okay? So if we execute at 410, we are risking just shy of 84 points per share. All right, so here's the breakdown of that. Buying 10 at a price not to exceed 410. Subsequently, if executed, we will have an exit strategy at 326.72 worst case. That's just the trigger. Market order to sell thereafter, and you'll notice once more our position size totally familiar and appropriate given the size that we're looking to not exceed. So we want to keep our positions fewer than $10,000 as well, or smaller than 10,000, I should say. All right, send that one off. There we go. So there you go, everybody. 2 quick ones, and I have a third one for us. So the third let us, and again, largely this is because our portfolio has dwindled down to 3 positions. So I'm trying to rebuild it, want to take advantage of some of these opportunities, of course. So let's see next up here, microchip. Similar pattern under development. This is so common. You know, you get a scan tool giving you 20 stocks, 30 stocks, 40 stocks, and you've got half of them trading at highs, half of them in the midst of the pullback, many of them showing similar, if not identical trends. Here, you've got the same thing. From the peak at 106, just shy of it, break of the downtrend line. Now today, testing the 20-day, holding the 50-day after a test of there. Now, I think the microchip position, given the proximity of the 20 and 50, it makes sense to consider the 50-day. If you're wanting to give yourself the greatest chance of staying with the trade, well then let's go with the slowest of these trending moving averages. Today, that's the 50-day at 89.72. So, currently, the ATR at $5.55. So we're going to go do the math. 89.72, today's closing 50-day moving average, less the amount of our ATR at $5.57. And that gives us an exit at what will be 84.15 for our stop order. Okay, so 84.15, that's our stop. Now, from an entrance standpoint, yeah, we need to give this some wiggle, right? We got to go with an elevated limit. My math here pre-work was to do a entrance, let's see, at 97. That would give us about $1.40, $1.35 of wiggle versus today's close. That might not be enough if we're being honest. If tomorrow flips bullish right off the jump again, we might miss out. So it may make sense to pop that up again to maybe 100. At least as long as it's under 100, we'd be in the position. But again, we have to make the adjustment for the risk factor. So if we buy at 100, and we could, if it's a limit at 100, it means that we could buy at 100. So that means we are looking at about 16 points of risk. So my math says we can, if we did have 16 points of risk, we could do 75 shares. Ooh, we can't do 75 shares. Excuse me, that's $1,200. So let us cut that down. What do you say we do this one in increments of 25? We consider 25 now to put us into the trade. And then y'all can remind me that down the road, if and when this breaks out, let's say we hold the 50, we get back into the prior high around 106, y'all remind me. We said we'd buy more. If we move to new highs, we should be confident adding to a winning trade. So let's see if that goes our way, but let's start small. We'll put ourselves in 1/3 of the trade. Ultimately, we may very well find that we can only own 50 shares, but let's start with 25 and give it a go and see if it could start working for us. So we'll start with 25 at a limit of 100 with a subsequent exit for stop at 84.15. So let's give that one a go. And we will right click, buy with custom and with stop. We're going to go to do only 25 shares. So if this just doesn't get going right away, then so be it. If it breaks down, we're going to lose a very comfortable amount. 25 shares. If we give back 16, it's a $400 loss approximately. Our comfort was up to 1,000, so this fits. So we'll make sure to be limited tomorrow for no more than 100 a share. That'll give us a nice wiggle room there. And our stop, good till canceled, is going to come in at 84. Now my math says 84.15, but you all know I loathe those nickels and zeros. So we're going to come beneath this. Let's do 84.07 as a stop. Nice non-round figure, right? And just as a reiteration here, everyone, why do we not like the zeros and the quarters or the nickels, that is? It's just because it's human nature to fall into that trap. I do it all the time. You see me with even the share totals I'm using. I'm doing increments of 5 here and 10 there or what have you. Human nature just leads us to take these easy shortcuts, right? And so I'm trying to reduce that risk by going with a less round figure, an odd number. Then I'm falling away from the individuals who default to using zeros and nickels just by human nature. That's all. So hopefully this gives us a little bit better likelihood of sticking with the trade. All right, so 25 shares at a limit not to exceed 100. And if we get it, we will then have an exit strategy only. And of course, position size here, pretty limited in scope, right? $2,500 is our maximum to enter the trade. And if it moves in our favor, then we'll consider adding to this one down the road. So let's go ahead and get that one sent. All right. So there you go, everybody. There's a brief discussion on ways traders may go about managing an example portfolio of equities, looking for new opportunities for equity trades within spaces of the market that have potentially given some signals that could work for short-term and intermediate-term traders. So with that, I want to thank you all for joining me here today. Big thank you to Connie, of course, managing the chat, and thanks to all of you for joining and for watching and participating as always. Now, we will be back tomorrow morning. This, of course, is the last live show of the day, but tomorrow I am live at Market Open. I'm joined by my buddy and fellow coach, Brent Morris, and we'll be taking you through Trader Talk at Market Open, so make sure that's on your calendar for tomorrow morning. We'll see to what extent this bullishness of the broader market may get going again, though today was more of a breather following yesterday's obvious exuberance. And so make sure you're following Connie and me on X, Connie Hill CS, Kevin Horner CS. You can also find me on LinkedIn if you'd like. I'd happy to have you follow there, of course. And make sure you're subscribed to the channel as well. Last note, if you don't mind, a thumbs up down below helps us out. We get this reviewed, archived into the list of archival, of course, and that thumbs up will help us on the replay basis for viewers who are unable to be here live. So, as always, really appreciate you joining me. I hope you all have a great rest of your Wednesday. I look forward to catching up with you all again real soon.